Good morning, and welcome to today's webcast, Qualified Small Business Stock Tax Strategies. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Chad Gumm, Managing Director, and Meghan Andersson, Senior Manager. With that, I'll turn it over to Chad to get things started.
Thank you. Yes, welcome everyone. Thank you for joining. Very much appreciate it. I'll introduce myself. I'm Chad Gumm, Managing Director here at Moss Adams. I'm in our M&A tax transactions group, and I also specialize in other corporate tax specialty areas, including qualified small business stock. Meghan?
Hi, everyone. My name is Meghan Andersson, and I'm a Senior Manager in the National Tax Group here at Moss Adams. I specialize in corporate tax matters, and I work often with Chad and his team on Section 1202 and other issues, similar issues.
Okay. Meghan, if you want to.
Oh, perfect. I will advance to the next slide. Yeah. So here's our agenda for today. First, we're going to discuss the background and benefits of Section 1202, also known as the Qualified Small Business Stock Provision. We're going to look at the congressional intent behind enacting this code section and the potential tax savings that can result if a shareholder in the corporation qualify. Then we're going to discuss the basic requirements, starting a little bit more high level about those requirements and looking at when and how Section 1202 applies. Then we're going to look at the specific requirements. Some examples include the gross asset tests and the active business requirement. Then we're going to look into tax planning strategies, and we're going to look at a few examples of some of the tax planning strategies that taxpayers often utilize to qualify for 1202 or to attempt to qualify. And some examples are entity conversions and qualified transfers. And then finally, we're going to talk about pitfalls to avoid or traps for the unwary, so that you can have that on your radar if you're looking to qualify for Section 1202. Some of those include disqualifying redemptions that occur within a certain period surrounding the stock issuance, as well as certain transfers of QSBS that can disqualify the stock. And so this brings us to our first polling question.
All right, thank you, Megan. And our first polling question of the day, what brings you here today? Either A, I'm considering selling my stock. B, I'm considering investing in a C corporation. C, I have questions about Section 1202 planning techniques. Or D, I'm just here for CPE. So if you select the answer on your screen and click the submit button below, your polling question will be recorded today. And as a reminder, you do have to answer 3 of the 4 polling questions to receive CPE credit. I'll give you about 10 seconds here to answer this question. All right, we're at about 85%. So a couple more seconds here, and I'm going to move on to the results. All righty, let's check out the results.
Awesome. Okay, so about half are here for the CPE, but by the time this is over, I think you'll be very interested in Section 1202. And then our next most popular response was people who have questions about Section 1202 planning. And a few people are considering selling their stock or investing in a C corporation. Awesome. So now we will get into our first section, background and benefits of Section 1202. So looking at a high level, what is Section 1202? So this code section permits certain shareholders in a C corporation to exclude from federal gross income a portion or all of their gain realized upon selling qualified small business stock, also known as QSBS, that is held by a shareholder for at least 5 years. So only certain shareholders qualify. The corporation must be a C corp, and the stock must be held for at least 5 years generally. And this is a federal income tax benefit. Some states follow Section 1202 wholly or partially, or just not at all. So that's definitely something to keep in mind. And the stock must generally be issued after August 10th, 1993, which is the date that Section 1202 was enacted by Congress. The potential tax savings are significant. We're seeing a lot of interest in Section 1202, especially in recent years. Though it's important to note that the amount of gain that can be excluded is subject to limitation. Generally, it's the greater of $10 million, or 10 times the adjusted basis in the stock. So you can only imagine if an investor has a high basis in his stock, let's say he contributed, $10 million to the company in exchange for the stock, that's a pretty significant exclusion, generally. And so here is a chart that kind of outlines how much gain can be excluded, and it's based on the date the stock was issued. So stock issued, 30 or so years ago when this provision was enacted, the original exclusion percentage was 50%, all the way up until 2009. And then for about a year or so, 2009 to 2010, the exclusion percentage increased to 75%. And now, after September 27th, 2010, so for the past 14 years or so, the exclusion percentage has been 100%, with no AMT preference item treatment, meaning just 100% exclusion for eligible gain. And we're seeing Section 1202 be very popular now because of the lower 21% flat C corporation tax rate that was passed along with the Tax Cuts and Jobs Act back in 2017. So yeah, that's a handy chart there. And now we're going to look at an example of what tax savings might look like. So some assumptions here are that the stock is issued after September 27, 2010, such that the exclusion is 100%. And we are also assuming the stock was held for at least 5 years and that all other requirements are met, which we're going to discuss later on. We're also assuming all the gain is eligible gain. So we have two shareholders, a founder and investor A. we're going to assume that the founder paid $1,000 for his shares, and investor A paid $5 million for her shares. And we're going to also assume the sale price for the stock is $50 million. So generally, the founder has close to $50 million amount realized on the sale, or gain realized on the sale, and investor A also has a high gain realized. So without QSBS provisions, without Section 1202, assuming the stock, if it did not qualify, founder's looking at a $12 million tax, and investor A is looking at a $10.7 million tax. So then if we look now at the eligible gain, assuming all that gain is eligible, you'll see that founder is able to exclude $10 million, which is $10 million is the lifetime limit, the greater of test. Investor A is actually looking at an exclusion of $50 million because investor A contributed $5 million in exchange for her shares, and 5 million times 10 times adjusted basis is a $50 million. And not getting too much into the math here, but the big takeaway is that investor A, who had a high basis in her stock, she has zero tax now upon selling her shares in the QSBS scenario, whereas the founder still has less tax, but it's still, relatively high compared to investor A.
Okay, thanks, Megan. I'm gonna start now talking about the specific requirements. A couple of things that I just wanted to touch on real quickly. First of all, you'll see in the thing that there's a Q&A box. If you have any questions, as I see some people have submitted some questions, please don't hesitate. Some of your questions may be answered later in the slide deck. If we don't get a chance to answer it, we might have some time at the end to answer, but if we don't, we will follow up and answer your questions after the training session. Then two other things that I kind of wanted to touch on just at a high level as something to keep in mind as we go through this. Two things. One thing, we're going to cover these requirements at a high level. Some of the requirements you'll see are pretty straightforward, and in most cases are easily determinable, but other requirements there's a lot of nuance and issues in there that make it we could probably spend a couple more hours digging into some of these requirements, but we don't have that time. But it does you'll notice, and we'll try to kind of emphasize where it does require some digging into some of these issues a lot of times, and it's not so easy to answer these questions and whether or not the stock can qualify. And it actually takes some analysis to do. The second thing to keep in mind is that, despite these rules being around for the past 30 years, there's actually, except for very limited situations, there's very little guidance out there on how to interpret some of these requirements and these rules. Neither the IRS has issued much guidance, except in limited situations, and there hasn't been many court cases that have where these issues have gone to court and the court has decided some of these issues. And so a lot of times we're kind of just left interpreting these issues and what we think the IRS would accept. So there is a lot of that, and we'll kind of touch on that in some of these things. So anyways, what is QSBS? Well, it's qualified small business stock, and there's kind of a laundry list of requirements that need to be satisfied that, in order for the shareholder to receive the benefit from this. So one of the most important thing is that it's got to be stock in a C corporation. So it can't be, a partnership or an S corporation that does not qualify. A limited liability company, if it's formed as limited liability company, but it's elected and checked the box to be treated as a C corporation, that can qualify. But just if it's a default limited liability company that has partnership tax treatment, that is not going to qualify. Also, the stock has to be, as Megan mentioned, has to be issued after August 10th, 1993. And if it's issued obviously after 2010, you get that benefit of 100% exclusion rather than just 50%. After the date of the issuance, the corporation has to be a qualified small business, which we'll get into shortly. Also, during substantially all the taxpayers' holding period, the corporation has to meet the active business requirement. And there's a lot of nuances with that requirement. So it's something that isn't an easily answerable question a lot of times, except for very basic situations. There also can't be any stock redemptions that could disqualify stock that would otherwise qualify, and there can't be any disqualifying transfers of the stock. So, as I mentioned, there's kind of a number of different requirements that are required in order to get this benefit. And we kind of broke them up into two different buckets. One that is easily determined, or much more easily determined at the shareholder level. Obviously, is the shareholder an eligible shareholder? Well, the shareholder can determine that. Whether, how they were issued the stock or how they acquired the stock, whether that requirement was satisfied, and then obviously whether or not they met the 5-year holding period. But then there's a number of other requirements that really the shareholder doesn't usually have the necessary information to determine whether or not those requirements are satisfied. And they're really determined at the corporate level and really require a lot of the detailed information that the corporation has access to that the shareholder oftentimes does not. And so these are the qualified small business test, the active business test requirement, and then if there's any stock repurchases that could disqualify the stock. So we're going to get into now we're going to kind of move into and focus on the corporate level requirements and some of those issues. So first of all, what does it mean to be a qualified small business? And so this is probably, if you're familiar with these rules or even vaguely familiar with these rules, this is probably the one that most people are most familiar with. And that's that 50 million threshold test. And so the first thing is immediately after and at all times prior to the stock issuance. So whenever the shareholder receives their stock, you're testing at all times prior to it and immediately after it. It has to be a qualified small business. So one of the first requirements is that it's a domestic C corporation. So if it's a foreign corporation, doesn't qualify. And again, it's got to be a C corporation to qualify. And then the second requirement is that it's got to meet this gross asset test. That's the 50 million threshold test. And so the one thing that a lot of people misunderstand about this test is that what is that 50 million testing? It's not the value of the assets, and it's not even the book basis of the assets. So when you look at a company's balance sheet, it's not the total asset amount is the book basis. It's not the book basis either. It's actually the tax basis in the property. Generally speaking, there is one exception to that for assets that are contributed to the corporation. Those contributed assets, like say you contribute some intellectual property or fixed assets, property, those have to be valued at the fair market value of that piece of property that's contributed. But otherwise, it's just the adjusted tax basis of the property held by the company. So what we do is we look at like a tax basis balance sheet, or have to convert it from book basis to tax basis and look at the tax basis and see if that has gone over the 50 million threshold. And so if you're looking at a balance sheet, the company's balance might be above 50 million if it's just right above 50 million. But if you look at the tax basis, a lot of times that's less than book basis. So you might actually still qualify because you might be under that 50 million test. And then finally, we look at it's more on a consolidated basis, usually. So any subsidiaries where that's owned 50% or more, you have to include the assets of all of those subsidiaries in this test. So usually we look at a consolidated balance sheet as our kind of starting point, and then figure out what the tax basis is to see whether or not that 50 million threshold has been satisfied. So then the second test, the corporate level requirement, is this active business requirement. And this is kind of what I've alluded to, is it has a lot of nuances within this requirement. And so a lot of times, what we see is, a shareholder will either be about to sell their stock or has already sold their stock. And now they're, need to file their tax return, and they go to their tax advisors and say, hey, wait a minute, can I take this exclusion? And so, either through their attorneys or their tax advisors, there'll be a QSBS questionnaire. If you've seen these a lot, have been thrown around. And a lot of times, they'll send it to the company and the company can answer these questions, but a lot of times you don't really know all the nuances within each one of these requirements. So I find it very difficult that someone at the company, unless you're really well versed in these rules, to be able to answer all of those questions. And so, and a lot of times you'll see on the questionnaire, it will actually specifically say that can't be relied on for taking this benefit, but it's more kind of just more an information tool to be able to kind of ask the right questions of whether or not to stop and qualify. And this is this active business requirement is one of those really nuanced requirements that there's a lot of different components to it. And so one of the things is that for substantially all of the taxpayers' holding period, the corporation has to meet this requirement. And obviously the corporation has to be a C corporation. But the one thing to kind of take from this is that this requirement doesn't have to be satisfied the entire holding period, just as substantially all. But that term is not defined in the rules. It's not defined in the rules. There's no treasury regulations that the IRS has published to define this rule. There's no court cases or any kind of other guidance from the IRS to what substantially all means. So a lot of times what we do is we kind of look at other code sections that use that same term of substantially all and see what the guidance is under those rules to kind of see what do we think that the qualification here. So generally we get pretty comfortable if you meet this test 80% of the holding period. So if you think of like just a straight 5-year holding period, that would be 4 out of the 5 years would qualify. So you could theoretically fail this active business test for 1 out of 5 years and still qualify. Obviously you don't want to do that if you can help it, but nevertheless it's still possible. I've seen there's other guidance and other code sections where 70% can be substantially all. I've even seen some tax advisors suggest that maybe even 50% could qualify, but I wouldn't. It's more just kind of your own risk profile, how comfortable you would be taking it. But nevertheless, in theory, you could take that position, but it's really a shareholder by shareholder determination of what the risk profile it is. But if you satisfy the test for 80% or more, you should be probably safe. Hopefully the IRS will weigh in on this at some point in the near future. So then the next thing is the next requirement is that for that 80% of the assets of the corporation must be used in active conduct of one or more qualified trades or business. Now, usually, and we'll get here in a second here, most people think, well, of course, all of my assets are used in the active business, so it should be 100% all of the time. Well, the rules don't work that way. I mean, that certainly can be the case, but it's something, again, you kind of really have to look into this to make sure that test has been satisfied for, over the length of the holding period or the life of the corporation. And the other thing to kind of take away from this is that it's got to be one or more qualified trades or businesses. A corporation could have more than one trade or business, and it could have one qualified trade or business and maybe one that doesn't qualify. And so if it does have a situation like that, well, the qualified business has to better be 80% by value of the overall assets of the corporation. And then finally, the corporation must be an eligible corporation. There are certain types of corporations like DISCs, RICs, REITs, REMICs, or cooperatives that don't qualify for this benefit. So usually it's kind of your standard, just straight C corporation that will qualify. So what is that 80% test? I kind of mentioned there's a lot of nuances what's in there. So again, you've got 80% of the assets. And you look through at the subsidiary corporations, any subsidiary that's owned 50% or more, you look at all the assets of those subsidiaries as well in testing these. So if you have like a foreign subsidiary that has an ineligible type of business, that could be concerning because you have to exclude that from this 80% test. And then also there's a lot of, and I'm going to actually jump to the last bullet point, and this is kind of like the whole purpose of what the rule, this qualified small business stock rule is that it really was passed to encourage the flow of capital to small businesses and invest in startup corporations or very early on corporations. Will give them access to more capital and encourage that investments. And so usually in the very early on stages of the company, the first 2 years, a lot of these requirements for the active business test will be satisfied. And then also any kind of startup activities or R&D activities, and those type of expenses, those are all going to be, that those are permissible assets and activities by the company. But after you get past 2 years, that's where it can be concerning, because then you have this working capital test, that the asset test that comes into play. And of course, as I mentioned earlier, there's no definition of what working capital assets means. If you go by the literal definition of what working capital means for financial reporting purposes, that's usually looking at your current assets. And we don't know if is it just current assets, or would you net current assets and current liabilities? Or is it all working capital assets? Because you can think of like accounts receivable. Well, that's just kind of you haven't received payment for, yet the cash, from a sale of your product or whatever yet. And so you haven't even had a chance to deploy that capital in investing in your other assets or employees or whatnot. So should that be something that's excluded? But anyways, after the 2 years, you're only allowed to include 50% of working capital assets in this 80% test. So if the company has, typically what we see is like, if you have a really high cash balance or investment assets, those are type of assets that, would not qualify. Because again, they don't want, the rules aren't trying to get to like investment corporations. It's really looking at active businesses. And so they don't want companies qualifying if it's just, investment companies or things like that. So if you have too much cash for a long period of time, or investment assets that make up most of your value of your assets, you're probably going to fail this test. But even if, like, sometimes companies get like a big, they issue a round of financing where they get a big infusion of cash, and that makes up a lot of the value of their assets, you might actually not qualify for a brief period if the cash makes up a good portion of the assets of the company. You might fail that test until you kind of burn through some of that cash. So maybe for a few months, you might not qualify and satisfy this test. And so that's where you kind of really got to dig into this test. And then finally, the active business requirement is not going to be satisfied anytime that a 10% of the total value of the assets is in real property that is not used in the active conduct of a qualified trade or business. So, if the company owns, the warehouse where you're doing manufacturing, well, that's used in your active business. That should probably be okay. But a situation where you kind of have, rental property or, investment property, that's not going to qualify. And if it's more than 10% of the value of your assets, you're going to fail this test. So again, you could fail this test for a short period, but if it's for a lengthy period, it's going to mean that you're not satisfying the qualified small business test. Same thing also with investments, again, corporate investments in other corporate stock. If you have more than 10% in corporate stock, like investment assets, that's not going to qualify either. So now we're going to move on to our second polling question.
All right. Thank you, Chad. Which of the following businesses is more likely to be a qualified trade or business under Section 1202? A, real estate broker. B, manufacturing products used in the health industry. C, executive coaching. Or D, engineering. So if you select the answer on your screen and hit the submit button, your polling question will be recorded today. I'll give you about 10 seconds or so to answer this polling question. All right, we're at about 80%. We'll give you like 5 more seconds here. All right, let's move on to the results.
Okay, great. So yeah, it looks like most people selected manufacturing products used in the health industry. This was a little bit of a difficult question, and we're going to touch on qualified trader business in the next few slides. Executive coaching, probably akin to consulting, which is an excluded business. Engineering, also an excluded business. And real estate broker, probably excluded as well. So we'll hop to the next slide. So what is a qualified trader business? The code actually just lists a series of businesses that are not qualified. And so the term is actually defined by exclusion. And to date, there are no regulations that kind of go into detail about what these terms might mean. We do have about a dozen private letter rulings, which are informal guidance for taxpayers other than the ones that the ruling is issued to. So generally, taxpayers, if they want more certainty as to whether their stock qualifies, they can request a private letter ruling from the IRS. And if the IRS issues that ruling, that only applies to that particular taxpayer. Often other taxpayers might use those as guidance for what these terms might mean and for other uncertainties in the code. So the following are not qualified trades or businesses. Performance of services in the field of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset is the reputation or skill of one or more employees. So a lot of these excluded businesses might entail service businesses primarily, some professional firms, engineers, architects, accountants, lawyers, and such. And a qualified trader business also does not include banking, insurance, financing, leasing, investing businesses. Farming businesses are excluded as well. Businesses involving the production or extraction of minerals or other resources for which depletion is allowed. And then the business of operating a hotel, motel, restaurant, or similar business. So because we have very limited guidance on what these terms mean, it really hinges on the facts and circumstances. And if we're engaged to do an analysis on whether a business qualifies, we really drill into a lot of facts about the business and the history of the business. And if there's multiple businesses in that company, we'll look at each of those businesses to determine if the requirements met.
Yeah, and I would just add, I see there's been a lot of really good questions asked, about this issue and prior issues as well. And we'll try to cover as much as we can. But if we don't, answer your question, we'll try to follow up after this session. But there has been, there's a lot of businesses that are tangential to some of these excluded business that can't qualify. And that's where, as Meghan mentioned, there's been these private letter rulings issued by the IRS that were in those situations where it's like, well, and some reason it's almost all of them deal with the health industry type of business. And it's like, well, companies that kind of are tangential to the health field, but do they actually qualify? And a lot of times they do qualify, even though they're not, actually in the business of prescribing medicine or dealing with actual patients. And so it does, a lot of, like, as Meghan mentioned, a lot of facts and circumstances to kind of assess that.
Yeah, exactly. Thanks, Chad. And here's just a visual. Sometimes it's helpful to have pictures to kind of show what are some of these excluded businesses. And some we see more often than others. I think consulting and brokerage and health and engineering might be the ones that kind of stick out. Like, what is engineering? What does it mean for this purpose? Like, and we really drill into the facts. And I'll kind of touch on in the next slide. I've kind of summarized what the informal guidance has told us with respect to qualified trader business. As I said before, we can kind of gain insight by really looking into those private letter rulings and chief counsel memoranda that have been issued. So the central question, which was highlighted in one of the first private letter rulings, is essentially, does the company provide value to customers primarily in the form of specified services and individual expertise, or by using its tangible or intangible assets? So how does the company provide value? Sometimes you can tell by looking at the balance sheet whether they have tangible assets or intangible assets on there. It's not crucial if there's no tangible assets. A lot of the time there's, unbooked intangibles that don't really show up on the balance sheet. So again, a very facts and circumstances determination. There's quite a few private letter rulings on qualified trader business involving health services. Health services is one of the more popular ones that keep popping up. I think about like 5 or 6 of them involve health services. So some examples of businesses that have qualified under this informal guidance are companies that do researching, testing, and manufacturing of drugs and other products, such as tools used or prescribed by healthcare providers. So maybe a healthcare provider will diagnose someone and prescribe a medication or a prosthetic, and a company will build that prosthetic according to that person's body and deliver it to the person. The person who's building that tool, developing that tool, conducting the research, basically doing things other than diagnosing and treating patients, could very likely qualify as a qualified trader business. They're using their IP, they're using manufacturing facilities, et cetera, to deliver value to customers. And so yeah, some factors to consider for health services. Does the company diagnose or treat patients? If they do, how close are they to, or sorry, if they don't diagnose or treat patients, the company or the company's employees, how close are they to knowing about the diagnosis and treatment? And if they know about it, why is it to deliver this tool, product, et cetera? We also look at how the company's compensated. Are they compensated like how a physician or a medical provider would be compensated? And then does the company employ healthcare professionals like nurses and physicians and physician assistants, surgeons, et cetera? So that's health services. And then brokerage. Brokerage is another one. I think there's 2 or 3 PLRs or informal guidance on brokerage. And some examples of businesses that have qualified are companies that sell insurance products. You'd think, oh, that's clearly insurance broker. Why did it qualify? Well, they also perform some administrative services in connection with their business model. And so the IRS essentially looked at the dictionary definition of brokerage services, which is interesting. And they said a broker is a mere intermediary. And so here the company was not a mere intermediary connecting A and B. They also provided other types of services to their customers. And so that company qualified. And then there's an interesting example as well of a website which posted property for lease, and potential lessees could go on that website and reserve and like sign. It's kind of like an Airbnb type site, I imagine. And essentially the IRS there said that that's actually, they were acting as a mere intermediary. The website was just connecting two people, lessor with the lessee. So in that instance, that's actually maybe one of the only ones that they said it did not qualify. And then finally, consulting services is one we see often. There's 2 examples here. One's involving a staffing services company that did qualify, as well as a data migration and management services company. And in looking at whether a company is engaged in consulting, in the business of consulting, they look at, does the company provide advice and counsel to help customers achieve goals? Are they merely providing advice and counsel, or are they providing other things? If they do provide advice and counsel, is it ancillary to other services, or do they bill separately for that? Like, is it truly like a significant part of their business? Often we see companies that are providing like a product or service and maybe have consulting on the side. So again, facts and circumstances. Here's an illustration kind of summarizing some of the requirements that Chad went through a bit ago, as well as the slides I just went through as well. So to meet the active business requirement, you need a C Corp. The C Corp can have, this box in the lower right-hand corner kind of shows the types of assets or businesses that don't qualify for 1202. But the C Corp, if it's less than 20%, because remember that 80% test, right? At least 80% of the assets need to be used in a qualified trader business. So need to be actively used. So if you have some investment assets, some non-qualified trader business assets, if it's less than 20%, you might be okay, but you have to look at the entire holding period for the stock. The longer the stock's held, the more intensive the analysis. And yeah, and finally, I just want to mention most businesses really fall within that gray area. So, and now hand it over to Chad.
Okay, thanks, Megan. So I just wanted to briefly mention, touch on some of the shareholder level requirements. We kind of were focused on more of the corporate level requirements, but wanted to touch briefly on the shareholder level requirements. So, obviously, you have to be an individual, and there's some exceptions to that to qualify. And obviously, if you're a direct shareholder of the C corporation, that's all fine. But the rules do allow individuals to invest in flow-through entities that own the C corporation stock. So here we kind of give an example where an individual owns an interest in a partnership that owns the C corporation, and here the person invested in the partnership back in 2015. The partnership acquired the C corporation stock, or was issued, I should say, the C corporation stock in 2016. So that can qualify. So when the partnership sells the C corporation stock, assuming all the requirements are met, including the 5-year holding period, that gain is going to flow up to the partner, or the S1. But if they qualify, they can then potentially exclude that gain that they received through the partnership, and that it is flow through entities include partnerships or S corporations. It can also be limited liability companies that are treated as partnerships as well. But the one nuance here is that the rules require the partner in the partnership or flow through entity to be invested in that entity at the time the flow through entity acquires the C Corp stock. So in example 2, you see here where S1 acquired their partnership interest in 2015. The stock was issued to the partnership in 2016. So S1 is good, but S2 didn't come into the partnership until 2018. And so they weren't invested in the partnership at the time that the partnership received the C Corp stock. So S2 would not be qualified, would not get the benefit of the qualified small business stock exclusion. So you really need to be invested in the flow through entity at the time that the entity gets that C Corp stock. But the flow through nature, it can pass through to the owners of the flow through entity. The original issuance requirement, I know there were a couple of questions on this. And so obviously the shareholder has to get the stock through original issuance from the corporation in exchange for either cash, money, other property that's not stock, or compensation for services. A lot of times that's your employees, whether it's they're exercising stock options or just receive other stock as compensation for services. That can all qualify, but you cannot purchase stock from other shareholders that received it from the company. And so there are a few exceptions for stock transfers that can qualify, but those exceptions are limited. So generally you the shareholder have to receive the stock from the shareholder or from the corporation as originally issued stock. For stock options, warrants, and convertible notes, those can qualify, but the 5-year holding period doesn't start until the options or warrants are exercised or the convertible notes that get converted into stock. But if the shareholder makes an 83B election, you could start that holding period sooner before the actual exercise of the options or warrants. So sometimes shareholders can differ depending upon their own individual situation. So quickly, we wanted to kind of touch on some traps that oftentimes get missed, and we'll talk about this in a few more slides later on. Obviously, stock redemptions, as I mentioned earlier, they can disqualify other stock that would otherwise qualify if they're if the stock redemptions are significant, depending on when they occur and when the stock was issued. Certain disqualifying transfers, obviously purchases, or other transfers that don't qualify, would not, you would not get the benefit from the rules. When you convert a partnership to a C corporation, that can qualify potentially, but if the value, you run into this potential $50 million that qualified business test, the 50 million threshold. If you convert the partnership when the value of the assets is greater than $50 million, then the stock's not going to qualify, because remember, I mentioned that there's this exception for contributed assets. And so when you convert a partnership to a C corporation, there's this deemed contribution of the assets to the C corporation in exchange for the C corporation stock. And so if the assets, the value of the assets is over 50 million, it's not going to qualify. But if the partnership
we'll
assets,
have examples of these as well. Sorry, just to chime in. We'll have examples of these going.
Good point. And then S corporations, if you just terminate an S election, that's problematic. You're not going to get the, even though you go to a C corporation, that's not going to work. Again, holding too much cash or investments, as I touched on that earlier, that can be a problem, or engaging in excluded businesses, as Meghan covered earlier. So now we move to our third polling question.
All right.
Chad,
Yep, got it. And our third polling question of the day: have you or your clients considered converting an entity to a C corporation to take advantage of Section 1202? Either A, yes, we have done so. B, yes, we have decided against doing so. Yes, but we've decided against doing so. C, no, most of the time the entity is already a C corporation. D, no, for other reasons. So I'll give you, if you just select your answer on the screen and hit the submit button, your polling question will be recorded. We'll give you about 10 seconds or so here to answer this question. All right, we're at about 90% almost, so a couple more seconds here. We'll move on to the results. All right, let's check out the results.
Okay, so it looks like most people said no, they have not considered converting an entity to a C Corp, which is what we'd expect. Not everyone has that fact pattern. Although it is becoming increasingly more common, it's a question that really pops up often about partnerships and S Corps wanting to convert to C. So we're going to start with an example of an S corporation. And this is, so generally a shareholder must receive their C corporation shares in exchange for non-stock property. That's the original issuance requirement we touched upon earlier. Shareholder must contribute cash or other non-stock property in exchange for shares. Merely revoking an S election does not transform those shares into QSBS eligible shares, because the shareholder must receive their C Corp shares in exchange for the eligible consideration. So you look at example 1, where an S Corp essentially transfers its, or sorry, a shareholder, there's an S there, shareholder transfers its S Corporation shares to a C Corp in exchange for C Corp shares. Those C Corp shares will not qualify because it's a stock for stock swap, and generally those don't qualify. Whereas in example 2, you have a shareholder who owns an S Corp, and the S Corp transfers assets assets to a C Corp in exchange for C Corp shares, such that the S Corp is actually the shareholder. If the individual up top, it should be I, but the individual up top qualifies under the pass-through rule that Chad touched upon earlier, then the individual should qualify to exclude its pro rata share of gain, subject to all the requirements. And a conversion, if done correctly, and I want to emphasize if done correctly, generally would start that 5-year holding period when it's done correctly. And next I'll talk about a partnership conversion. So partnership conversions do qualify if certain requirements are met. Generally, when a partnership converts to a C Corp, whether it checks the box to be a C Corp or converts, there's different ways to convert, but generally the partnership is deemed to contribute its assets and liabilities to a new C Corp in exchange for shares, and then distribute everything up to the partners and liquidate, such that the former partners, now shareholders, own a C and not a partnership. Generally, the step 1 will meet the original issuance requirement. Step 2 can also be a qualified transfer. However, it all depends on the value of the partnership's assets at the time of the conversion. If you recall, that $50 million gross asset test said that at the time of the issuance and at all times before and immediately after, the gross assets of the company cannot exceed $50 million. Well, you might say the basis doesn't exceed $50 million. The aggregate gross basis of the assets is only 25. However, there's a special rule that says when property is contributed, you actually have to consider the fair market value of the property for purposes of the gross asset test. So this is why when partnerships convert to C Corps, we highly, highly recommend that the entity get a valuation done to make sure that it's under that $50 million, such that that test is met. We also want to highlight that this is a good way, if done correctly, for shareholders to receive a greater exclusion when they do go to sell the shares. And that's because, the rule will look at the adjusted basis of the contribution. And if let's say the partnership was valued at $40 million, 10 times that spread across, the partners or shareholders is actually a pretty hefty exclusion, subject to some limitations on any built-in gain at the time of conversion. So I know that's a lot, but definitely this is a popular one, and definitely reach out to us to discuss if you have any further questions. And next, we're going to talk about tax-free and other transfers. So as we touched upon previously, you can't purchase, a shareholder stock will not qualify if they purchase the stock from someone else. Other transfers of stock don't qualify, whereas some transfers do. Generally, transfers by gift or at death will qualify. Transfers from a partnership to a partner can, but not vice versa. Generally, the transferee will step into the shoes of the tax transferor if it is a valid transfer. And then there's also an exchange rule. I'm actually going to talk about that in 2 or 3 slides where there's an example. So just for the purposes, in the interest of time, I'm going to hop to the next slide. This is an example of transfers by gift. We often get questions, what happens if a shareholder contributes shares to a trust? Is that like another taxpayer? Whereupon we can maximize our exclusion. Well, transfers via gift are acceptable, but we have to look at the reason for the transfer and the details of the transfer. So let's say, in example 1, we have a shareholder that owns 100% of a C Corp, transfers 25% of the shares to a non-grantor trust for child 1 and another 25% to a trust for child 2. First of all, I want to iterate that the gain exclusion is on per taxpayer basis. So a grantor trust is not considered a separate taxpayer, whereas a non-grantor trust is considered a separate taxpayer. So there is the potential to maximize gain exclusion if that's done properly. But let's say you have an example 2, you've got 2 children you create 4 trusts for those children in the hopes of quadrupling your gain exclusion. That one might be a little more gray because, you know, you'd want to look at the overall estate planning goals. Is there a reason why we have 4 trusts for 2 kids, etc. And there's different anti-abuse rules out there as well to keep in mind. And then the last, the example I have here is a stock reorg. So if a shareholder owns qualified small business stock and transfers it in exchange for other stock in a tax-free transaction, the new stock can be treated as QSBS, but it depends on whether the new stock is qualified small business stock as well. If the other corporation, like in example 1, if the other corp is not a QSB, there's only a partial benefit. Whereas in example 2, the other corp is actually also a QSB. It also meets the aggregate gross asset test. It's a C corp and other requirements are met. Then you might get the full Section 1202 benefit. Chad.
Okay, thanks, Megan. We're kind of running out of time here, so I wanted to just kind of quickly mention this. As I mentioned, significant redemptions can disqualify stock that would otherwise qualify. So there's really 2 things to keep in mind. One is there's rules that apply to specifically the shareholders that's having the redemption from. So if the corporation redemption from shareholder A, there's specific rules that kind of extend the dates that you have to worry about disqualifying stock. If it's just a significant redemption, that can apply to any shareholder that was issued stock within a 2-year period of that redemption. And so I'm going to go to the and there's some de minimis. If it's a really small repurchases, that won't disqualify the stock. It's really significant redemptions. So I'm going to go to this example. So if you have a stock issuance on, say, June 30th of 2023, and it's just us, and it's not, and the redemption or the stock repurchases happen 6 months later. Okay, well, it's not, we're not talking about that specific shareholder, just all shareholders. Well, there's a 2-year test, 1 year prior to the issuance and 1 year after the issuance. And if there's a significant repurchase within that time period, that's going to disqualify this stock that was issued within that 2-year time period. And so you kind of run through the significance test and de minimis test, and if it exceeds both those tests, then it's going to disqualify the stock. So the moral of the story is, anytime the corporation is making a stock repurchase, you want to make sure, if there's any, obviously if any shareholders want to take a benefit of the qualified small business, that the stock repurchase doesn't disqualify the stock. So you want to really make sure you have your ducks in a row and not do something that could disqualify stock for the shareholders.
And I think with 2 minutes left, we're going to hop to our final polling question, just to make sure that people can.
All right, and our fourth polling question of the day. After this webinar, do you have a better understanding of Section 1202 requirements and tax strategies? Either A, yes, B, no, or C, maybe. And we'll give you about 10 seconds to answer this one. All right, about 5 more seconds here. All right, let's check out the results.
Oh, yay, that's great. I'm glad we got a lot of yeses. I'm probably going to skip over a key takeaway so I can give Jen Menendez a chance to talk about our transaction projects group. But we are keeping track of all your questions, and we will reach out to you individually. And thank you so much for attending. Jen? Oh, advance.
Thanks, Megan. Hi, everybody. I'm Jen Menendez. I lead our transaction tax projects group here at Moss Adams, and just wanted to jump on real quick to say thanks for joining us today. This is the last of a 4-part webcast series that we did. And so if you're interested in learning more about any of these other areas, we did 382, 280G transaction cost analysis. Those were recorded and available on our website, or feel free to reach out to any of us if you need help with any of those issues. Over to you, Chad.
Chad P.
Awesome. Thanks, Jen.
Yeah.
Thank you, Chad and Megan, for a great presentation today. And if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's webcast presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certificate requirements, your certificate is available for download now in the CPE progress window. I'll keep the webcast open for a few minutes to give you time to download your CPE certificate. If you're unable to download your CPE certificate today, a copy will be emailed to you within 3 weeks. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this as your feedback is very important to us. Thanks again for joining us today, and we'll hopefully see you next time.
Thank you.
Yep, thank you.